Property market review. So let's start with the sales, and the real heading for sales at the moment is very much that price growth is at a 4-year high. Now, I think it's safe to say that 2020 was definitely a year like no other for obvious reasons, and certainly from a property market point of view, it's really defied expectations in the last year, with the UK experiencing its strongest annual price growth recording since the summer of 2016. So, as I say, that's at 7.6% in the last year on average, which is huge. Now, to close out 2020, December alone saw over 129,000 homes change hands, which is 32% higher than December of 2019. And realistically, what this did is only add to what is always a mad rush in the middle of the month to hit clients' exchange deadlines so they can enjoy Christmas with a bit of peace of mind that they know their deal's over the line. So really busy December all around. The mortgage market has also recovered, with the Bank of England reporting approvals to be up 3.7% on the previous year. Already this year, we've seen more mortgage products released again, particularly on 90% loan-to-value mortgages, which of course will help first-time buyers. And with an estimated 10% more sales agreed in 2020 than in 2019, the start of 2021 has been positive. The new year itself was reported as being the busiest ever start to a year by our friends at Rightmove, with visits to the website up by 30%, and sales property inquiries up by 11% compared to the same period a year ago. Now, they have also reported that sales agreed in January are up by 9% year on year. However, we've seen new supply of properties come to the market reduced by 12%, and the total number of homes for sale down by 6%, as new sellers still remain a bit cautious whilst lockdown restrictions remain. This has caused a supply and demand imbalance, and of course is maintaining upward pressure on prices, but with surveys suggesting that a large percentage of would-be sellers are holding off due to the pandemic, perhaps we can expect a surge of new supply towards the summer as lockdown measures are eased. So I'll be interested to see how the year plays out for available stock. Many sales are currently in the conveyancing process. In fact, there are approximately 650,000 transactions currently going through, and the process has been a lot slower, meaning heightened levels of stress for a lot of home movers, especially those who were pushing for the stamp duty deadline that was previously set for the end of this month. But that stress has, of course, been lifted for so many with the latest budget announcement, as the stamp duty holiday has been extended to the 30th of June. So there's definitely some breathing space and opportunity. Now, of course, the Chancellor's budget announcement was on the 3rd of March and actually represents a number of changes and factors for the housing market. So here are my 4 key takeaways. This is really what I've noted down, what I've taken out of it. So as we're on it, starting with stamp duty. So it's a 3-month extension from the end of March to the end of June, meaning that stamp duty is only payable above the threshold of £500,000, which represents savings of up to £15,000 on purchases. This does, however, exclude the 3% second property surcharge on buy-to-let purchases. Furthermore, to avoid a cliff edge, when this period ends, the tax-free threshold will then drop from 500,000 to 250,000 for a further 3 months before finally returning to the normal level of 125,000 from October the 1st. This is absolutely huge news, as savings of up to £5,000 can still be had for completions across the summer months. So it's going to be like a phased exit now to this stamp duty holiday. So it's a lot of opportunity comes with this. Now, the second takeaway, number 2, is around back to the mortgage conversation. So 95% mortgage guarantee scheme. I said earlier that the return of the 90% loan-to-value mortgages has already helped more first-time buyers get back into the market, first-time buyers in particular anyway. And there's been a 5% rise in demand from said first-time buyers in the first 6 weeks of the year. So that kind of tells a story. Sales of between £100,000 and £250,000 have also seen an increase of around 18% in the first couple of months of the year, which is in keeping, as buyers of lower value properties tend to be more reliant on the availability of finance, especially at higher loans values. So a bit more about the mortgage guarantee scheme. It's basically a part of a government initiative to turn generation rent into generation buy, and basically means that the lenders who sign up for it, and so far the likes of Lloyds, Santander, Barclays and HSBC are all involved, can purchase an insurance from the government to cover some of their losses if the property is repossessed. So it's a bit like an indemnity policy. So a safety net for the lenders to be comfortable offering high loan-to-value products to buyers again. And this is not just for first-time buyers either, but also existing homeowners and those trying to remortgage with low equity. But of course, This does exclude buy-to-let mortgages, which will still remain at a minimum of around about 25% deposit required if you're looking for a buy-to-let mortgage at the moment. The third takeaway is regarding tax thresholds being frozen. So a number of tax thresholds, including those for capital gains tax and inheritance tax, most notably, will be frozen until April 2026. Capital gains threshold will be held at £12,300 for the 21-22 tax year, whilst inheritance tax remains at £325,000. So this means tax payable only kicks in above those amounts. So who does this affect? The move to freeze capital gains tax means anyone selling an investment property or a second home will have to pay capital gains tax of 28% on any increase in the property's value since they first bought it above £12,300. And I've put this little section in here because obviously there's a number of landlords that have been thinking about or have actually started trying to sell up a few of their properties of late. So I thought it was definitely something to talk about very briefly. Now, with this, couples who jointly own a property can combine their capital gains tax allowance to £24,600. So always bear that in mind. Inheritance tax is paid at 40% on all assets worth more than £325,000 that are not left to a spouse or civil partner, although this threshold increases to £500,000 if you leave your home to your children or grandchildren. Of course, this speculation over a hike in capital gains tax, as I said, has already seen some landlords act, and we have seen a spike in the sale of previously rented homes. But with this 5-year freeze, this may well reduce the number of landlords thinking to sell again. I don't know. We'll see what happens. So the number 4 and the final one from the budget is the extension to the furlough scheme, which will be extended until the end of September. I've put this in here for 2 reasons. Firstly, if the government is continuing to support people's incomes who can't currently work or don't yet have a job to go back to, then of course they're less likely to struggle to keep up mortgage payments, meaning we are less likely to see a spike in forced sales or repossessions that some have been speculating. And secondly, for all landlords with tenants who are being supported by the furlough scheme at the moment, it means they are less likely to struggle to keep up with the rent payments, which is a definite positive for all of us, of course. So that's the main takeaways from the recent budget, the impact property market. And sees us really wrap up the sales section. So now just going into the lettings focus. And to start with, we're still seeing average rents across the UK rising, with a 1.4% increase across the last year. Interestingly, though, Zoopla reports some major cities to have decreased, with London most notably dropping by around 8%. And more locally, Birmingham is apparently down by almost 1% on the whole year on year. So if we take London out of the equation, excuse me, if we take London out of the equation, then the UK increase would in fact be more like 2.5% year on year on average. This is expected to continue for the foreseeable future. So, guys, I'd always encourage regular tenancy compliance checks, or health checks as I like to call them, and a rent review is something I personally tie in with those checks, as it's always good to know where you stand versus the current market rates. I certainly don't encourage trying to squeeze every single penny in terms of increasing your rent and stuff with tenants. If you've got good tenants, I think it's also important to try and keep them and look after them. But it's certainly a lot easier to creep up the rent from time to time in small increments and fall really far behind the market rate and then try and add a big increase in one go further down the line. So just always keep an eye on it and just see where you're at. A few other interesting points to note, starting with a look at where the demand is at its strongest. And it appears that the commuter belts are stronger than main cities themselves right now. So if you take our area, for example, rents in Birmingham, in central Birmingham, fell by 3.5% in the year to December 2020. But average rents across neighbouring boroughs, including Bromsgrove, Sandwell and Wolverhampton, where we are, rose by an average of nearly 5.5%. So effectively, people are looking for more space, and they're not going to achieve that in the central areas. You're looking at more flats and smaller properties in the central areas, of course, especially at a probably more premium rate up until recent times. And obviously, just as my area is Wolverhampton, and a lot of you guys watching will also be from Wolverhampton, a bit more local, I just want to advocate why our area is great to invest in for anybody who is actively looking. We're seen as the best value commuter area outside of Birmingham. This goes hand in hand with what I've just said about the demand, and it takes into account the average cost of rent or mortgage payment plus annual train fare. Second behind us is Cannock, so obviously another area that is worth looking at. The second reason, the average gross rental yields are now above 6%, which is actually higher than the general average for the West Midlands. So Wolverhampton now is benefiting from fantastic gross yields. And the tenant demand is unbelievably high right now. And there's a real supply issue in the local rental market on the back of it. Now, we've personally seen a further 50% increase in the amount of tenants registered into our database this year alone, which was already up by about 50% during last year. So it's a phenomenal amount of tenants coming in at the moment. And Rightmove have reported an increase in inquiries by 22% on properties for let in the new year so far. So really, it's all perfect ingredients for buy-to-let. And I'll leave that there because I know, you know, what's the right buy-to-let is different. It's personal. It's different for you know, certain types of investor. But if anyone wants to discuss that further, I do have a buy-to-let advisory service which you can contact me about if you want some help, or you know, if you're interested. So yeah, so that concludes my you know, my spring market update. I hope you found it useful. If nothing else, a little bit, you know, maybe interesting. Now, as I say, I do want to hear some opinions. So if anyone's got anything to add, or if anyone disagrees with anything I've said there or reported, please feel free to put it in the chat. Tell us what you think of what the current climate's like and what's going to happen in the future. If you're out there buying and trying to pick up some buy-to-let opportunities at the moment, what are you experiencing? How busy is it? You know, how competitive is it at the moment? I want to hear your views. So like I say, use the chat, get in touch.